The stock market will never make you rich. Instead, you need to do something like real estate or building your business.
I don't understand why you can't just do both. This guy's probably heavily invested into real estate. Hey, so today I'm going to be reacting to some popular economic and finance content out there. Again, I haven't seen these videos, so let's get into it.
Thanks. Thanks so much. Here you go.
Thank you so much. Here you go.
Thanks. Thank you.
You know, there's been a lot of talk recently about how, this AI bubble or, growth rather, is fueled by a lot of these transactions, one company buying out another company, buying out another company. Does that mean we're in a bubble when the price inflation of all these AI companies is being fueled by people or companies purchasing and acquiring and sending dollar bills to each other, and that's causing the stock price to go up? Well, it's not entirely an unreasonable assumption, but it is interesting to see a lot of the news coming out is just, acquisition here, acquisition here, acquisition here, and all these stock prices go up and up and up, even though nothing really has changed. But we'll see how this affects the market. I don't really think this is the top of a bubble. If anything, it may be the beginning. I mean, realistically, if you go back to the 2000s, dot-com era, you can see the charts of the NASDAQ. The bubble really didn't explode higher until the last year or so of the whole mania. So you had the incremental price increases in the 1990s, and 1998, 1999, you really saw the big explosion higher. Even though arguably the bubble factor could have been started, a handful of years earlier. So, love Kevin O'Leary.
That's the other thing. Never use margin in stocks. Never do that. Never. People think margin's free. When there's a correction, you get slaughtered.
Right.
They'll sell you out.
As a generalization, the use of margin when you trade stocks can be misused. And I think in general, when people use margin or the desire to use margin, generally there is kind of a misuse there because the desire is for the leverage factor. And obviously when you use leverage and things go up, it's great. When it goes down, you get wiped out. But margin is actually a very useful tool when you have to adjust and get out of positions, right? Especially when you trade options, a lot of times you have capital that needs to be tied up maybe just for a day or so because your option expires in a few days, or you're getting in and out of certain positions. And in that case, margin is actually used as a tool that it's supposed to be used as in the way your account has flexibility, so that if you have to get out of positions and it takes maybe a couple days to readjust everything you have, you don't have to sell out one thing to generate the cash to then put it in the other position. You can do it in one seamless transaction because the margin kind of lets you do that. But using margin for leverage, I think, is a pretty accurate description. You don't want to really do that unless the upside's one thing, but if you've ever been through a correction, you can see how very quickly and easily your account can go down and down to the point of never being able to recover.
Will there ever be one world currency? I mean, maybe, but the thing is, governments like having their own currency because it allows them to print when things get tough. If you're Greece and you run out of money and you're part of the EU, you can't do shit. You don't control the printing press for the euro. You just have to beg, which they did. People other than their own government had to come in and put austerity measures on them, cut their spending, and choose what they could do. So nobody wants a one world government. Everybody wants their own currency.
I think this is true to an extent, right? I think if anybody is interested, monetary economics and the history of financial, positions of certain countries and empires throughout the centuries is actually one of the most fascinating parts about economics and finance, I think. But if people have studied that, you'll notice that there is this very specific pattern, a very methodical pattern that happens with currencies and countries' ability to control their currencies, right? Usually currencies are controlled by their own countries, right? But over time, there's always a handful, maybe one or two big world powers that actually have a currency that is actually used as a reserve currency by all the other nations of the world, right? And uniquely, the United States is in this position currently, right? So you could argue, one world currency, is that going to happen? I mean, to some extent, there is some element of that today, right? The US dollar is essentially the bedrock of nearly all financial transactions in the West. And even if you go to the Eastern hemisphere, Japan is essentially a fiefdom of the US, hegemon, and then China is attempting to basically take it down. So, you have these power struggles, but I think when it comes to the country's desire to have their own currency, I think that's absolutely true. The thing is how that country is able to get to a position where they have a currency that's actually stable enough to not just finance that own country's debts, but also be used as a reserve currency for the rest of the world. I think that is the goal of every country. And if you look at history, every nation that has come up as a superpower has also been granted the privilege of being the reserve currency, not because every country just wants that to happen and just gave them that power, but rather because the strength and influence of that country on the global stage was to the point where other countries had no choice but to use that currency as a reserve currency.
A top economist just compared today's AI hype to the dot-com crash and says it actually might be worse.
Torsten Slok from Apollo Global warns the market is wildly overvaluing big tech companies like Nvidia and Microsoft, with price-to-earnings ratios now even higher than they were before the 2000 crash.
Even more concerning, the top 10 companies' valuations far outpace the rest, suggesting AI-heavy tech giants are being priced well ahead of real profits.
It's a familiar pattern: massive investor hype, lofty promises, and not enough real revenue, just like in late 90s.
Slok and others say the top 10 S&P 500 companies are inflating the market, driven by AI expectations that may not materialize.
Companies like Meta, OpenAI, and Microsoft are spending billions on AI infrastructure, but if profits don't follow soon, we could see history repeat itself.
Nobody's going to look at the market and say, yeah, these AI stocks are cheap. But even with the dot-com bubble, even though there were a handful of companies, a lot of them, that were actually worthless at the end of the day, the internet itself was a revolutionary factor historically, right? So what tends to happen with bubbles, right? And this is why I think calling AI a bubble is a little bit misleading, because the actual technology of AI is there. It's here to stay, and nobody would disagree with that. The question is which companies are going to come out on top and dominate the space, and which ones are going to be left behind, right? This has been the case with the dot-com bubble, and then, actually the dot-com bubble is the easiest one to compare because the internet was very similarly a revolutionary phenomenon. You had a handful of companies that were dominating the space. A lot of them were left in the dust. The companies that actually survived did actually survive and thrive over the next 20 years. Right? Apple, Amazon, Microsoft, those are all around in the dot-com bubble, and they did have a momentary crash, but eventually those companies did recover because those were sound business models, right? So it's like, the question really isn't like, will AI crash or will there be a crash? Probably, right? But that's no different than the dot-com bubble in the 2000s or the crypto bubble that happened in 2021 and then subsequently crashed with all those altcoins that never survived. But then Bitcoin and Ethereum rode the wave down in 2022 and came back even stronger in just the last year, right? It's not really if AI is a bubble, it's really which companies are going to stick around and dominate the space over the next 5-10 years. This should be the real question for any AI investor.
Okay, how bad is it? It's okay, just say it. The numbers are really strong. What? The lending figures are looking really, really good. That can't be right. Average loan size is up, number of loans is up, arrears is up a little, but still pretty low. But our lending rates are so much higher than they used to be. I know. And the global economy is on the brink of recession. I know. And home prices are at record highs. It's not like people are bargain hunting. I know. Look, supply is still low and demand's pretty high. I guess that's all there is to it. So hang on, you're saying despite everything, more people are borrowing more and paying more to do it? Yeah. So what does this mean for us? Well, we're a bank, so it's the dream. Bonuses?
This is kind of kitschy. I mean, it's funny because, it's true, like interest rates are up. That obviously helps banks on a net basis. However, I think there's a huge misunderstanding of how interest actually plays into the banking sector. I think everybody thinks, oh, higher interest rates are good for banks. Well, yes and no, right? It really depends, because at the end of the day, if you are able to pay customer deposits 0% and then have, lend out at 7%, yeah, that's great, But at the same time, as we saw recently, when the interest rates went up back in 2022, there were a couple of regional banking crises because a lot of these assets that banks were holding got severely devalued because of the rise in interest rates. Remember that fixed assets, either bonds or even stocks, which a lot of banks were making loans, which means they hold the asset as a fixed income asset, right? Those assets went down in value when interest rates go up. So like the first period when interest rates go up isn't really good for banks. It's after the fact, right? It's after all those bad debts kind of clear out, are those banks able to then capitalize on the higher profit margin, right? It's the same thing if you're a stock investor, right? If you have a lot of stock in your portfolio and the market's going up and up, like, is that good or is that bad? I mean, well, for your existing holdings, it's good, but you're not really going to go bargain hunting and find stocks on sale. You're going to have to wait for a crash to do that. The first part of the crash is painful for your existing holdings, but then you can bargain hunt and find more opportunities that way. So it's kind of the same thing. I think, again, I'm not a banker, so I wouldn't necessarily know 100%. If you are a banker watching this, let me know in the comments if I'm wrong. But I mean, I think this is obviously an oversimplification, although it's kind of funny.
Speaking of money, how about the $20 you owe me?
Oh, yeah? Well, I only got 10, so here's 10 and I owe you 10.
Thanks.
Hey, Mo, you owe me 20.
Well, here's 10 and I'll owe you 10.
You owe me 20.
Here's 10, I owe you 10.
Here's the 10 I owe you.
Here's the 10 I owe you.
Here's the 10 I owe you. Good, now we're all even.
Yeah, that's a classic. You know, a lot of people would say that AI is a similar space like this. Just a bunch of banks, investments being transferred to one another, but no real value created. Maybe just in the short term, though.
The stock market will never make you rich. If you don't believe me, what I want you to do, go to a compound interest calculator and choose whatever interest rate you think the stock market's going to return you. Let's say 8%. And then I want you to figure out how long will it take you to even have $1 million, which is not rich. Probably going to take you at least 20 to 30 years. That is not a fast enough investment vehicle to actually retire young and to enjoy your life. Instead, you need to do something like real estate or building your business.
I don't understand why you can't just do both. This guy's probably heavily invested into real estate. One of the things I notice is people in real estate, right, there seems to be like this boundary where like one side like looks at the other and is kind of like looks down upon them, because like the stock people are like, oh, like look at your real estate guys, you have all this property you have to take care of, you have to actually do things for your money. We can just sit and watch our lines go up, right? And then the real estate guys look at the stock market people and they're like, huh, you lazy people, you have to pay taxes on your earnings. We can roll our taxes forward. You can't do that, And then there's this kind of like, because I've worked with both real estate clients and people who don't have real estate, and it's kind of this very different mindsets. The liquidity aspect of paper markets, stocks and options and stuff, is necessary if you're somebody in real estate who needs liquidity, but you can earn a much better rate over time than investing in the bank. So I would say do both, especially if you're in real estate. Stock market's a very good way to incorporate additional wealth into leaving money in the bank and watching it earn nothing. Hey, thanks so much for watching. If you enjoyed content like this, please like, subscribe, and leave us a comment. Thanks so much for watching. I'll catch you in the next one. Bye-bye.